What we need are more free markets, not federal micromanagement. Economic prosperity comes from the competition, innovation, and market-driven growth, not bureaucratic control. Reversing the Biden administration's heavy-handed approach and restoring a market-based framework for antitrust will help businesses innovate, invest, and create jobs. Hello, welcome to this week's Economy. I'm your host, Dr. Vance Ginn. Thank you for joining me again today. Look, we still got a lot of things happening. As you know, you probably turn on the news and you find something else going on. Federal government still shut down as I'm recording this on November 6th. I've got some other trips coming up, so I need to do this a little bit early. So maybe, just maybe, it won't drag on anymore and we can actually get past this federal shutdown. But, as it's entering its second month, or actually it's already in it, I think that today is day 36, which is the longest federal shutdown in history. It's also frozen a lot of the key economic data and labor reports that would normally come out to give us insight about what's happening in the economy. We did get the automatic data processing, ADP jobs report that said about 40,000 private sector jobs were added. So that's, a little bit of an uptick, but we'll see if that is maintained in upcoming months. Of course, this adds more certainty to already shaky markets struggling under tariffs, under shutdowns, and so much more that we have going on. Meanwhile, major developments are unfolding in the courts, from a pivotal Supreme Court case that could redefine presidential power over tariffs to an antitrust battle involving Pfizer and Novo Nordisk. At the state level, voters weighed in on key tax and spending measures that will shape local economies for years to come. There's a lot happening across every level of government, and each of these stories ties back to one question. How do we keep America's economy free, competitive, and growing? In this week's Economy, I explore this question in light of recent news. Remember, you can catch all the full episode on YouTube, Apple Podcasts, Spotify, and visit my website, vanceginn.com, for more information. Also, I'll let you know that my Substack newsletter, Let People Prosper, which you can find at vanceginn.substack.com, is a reader-supported publication, which also helps me with my publishing on this podcast as well. So if you want to support that, please do so. All right, let's dig into what's happening this week. Number one, U.S. government shutdown and economic data freeze. Well, in the news, the federal government shutdown has entered its second month, delaying critical economic data releases, including the monthly jobs report, for 2 months now. With no official data, the Federal Reserve and investors are flying blind, fueling market uncertainty and anxiety. My take on this is that we already have an economic uncertainty, and this is contributing to more. For nearly a month, America's largest employer, the federal government, has been running on fumes. This exposes how dependent our economy has become on borrowed money and bureaucratic control. The real tragedy isn't that some agencies are closed, it's that the people who actually drive prosperity and fund government, which are families, small businesses, and entrepreneurs, are paying the price for Washington's inability to budget responsibly. The data blackout means the Fed is now considering rate cuts without a clear picture of the economy, compounding the risk of policy mistakes. We also need budget reform in Congress. Congress hasn't passed a full budget on time since 1997. Instead of growing through shutdowns and continuing resolutions, lawmakers needed to adopt a federal spending limit tied to economic reality, end autopilot spending, and sunset unnecessary programs. They should also require agencies to justify their budgets annually. A return to 2019 pre-COVID spending levels, which were already too high, would be a good place to start. True prosperity, if America is to remain the land of opportunity, we must stop confusing government spending with economic growth. Bureaucrats don't build prosperity, people and markets do. The solution to Washington's dysfunction isn't another short-term fix. It's permanent fiscal restraint that restores accountability and unleashes real growth. Related to this, I discussed the shutdown in our national debt problem on the Joe Pag Show. Don't miss that in the show notes page. Number two, U.S.-China trade deals and tariffs. In the news, the White House has released details of new trade agreement between President Trump and Chinese President Xi Jinping. The deal de-escalates the U.S.-China trade war by cutting tariffs on Chinese goods, pausing Beijing's restrictions on rare earth exports, and resuming Chinese purchases of U.S. soybeans. Both countries also agreed to suspend retaliatory tariffs and ease export controls. At the same time, the U.S. Supreme Court is hearing Trump versus VOS selections, a case that could determine whether presidents can continue imposing quote-unquote emergency tariffs without congressional approval. And when you look at this, I really think that we're getting a little bit more on details of trade deals. It's encouraging, right, to finally see more concrete details of the U.S.-China trade agreement. Until now, the Trump administration has focused mostly on frameworks, broad outlines with few specifics. Without clear terms, businesses and investors have remained uncertain about what's next. President Trump's decision to roll back some of tariffs shows an understanding of their unintended consequences for consumers. Americans are already feeling the tariff impacts. Agricultural tariffs continue to hurt many Midwestern states, leading to farm bailouts by the federal government, meaning you and I, aimed at easing the burden. Meanwhile, surveys show that Americans are increasingly uneasy about the direction of the economy. The uncertainty tariffs create to businesses, investors, and consumers is already slowing economic momentum. The Supreme Court should strike down these so-called emergency tariffs to restore constitutional limits and let markets work as intended. The constant back and forth of tariff hikes and suspensions has blunted the economic potential and undermined growth. This new agreement with China could be another step toward breaking that cycle and restoring long-term stability and confidence. Related to this, I had a great discussion with Nick Craig on his show recently about the trade discussions with China. Check it out for more insights. I also wrote on the SCOTUS case on emergency tariffs that you can find in my Substack newsletter. All right, number 3, state tax competitiveness. In the news, the Tax Foundation has released its State Tax Competitiveness Index, which evaluates each state's tax structure across 5 key areas: corporate income tax, individual income tax, sales tax, and unemployment insurance tax, and property tax. Texas, where I live, with its strong no-income tax model, ranked number 7 overall. Voters also weighed in on several local and statewide ballot measures in Texas aimed at reducing the tax burden on homeowners and businesses. My take on all this is that you can look at the trends. The states that rank highest tend to either lack one or more major taxes or maintain flat, broad-based, low-rate systems. In contrast, the lowest-ranked states are burdened by complexity, narrow tax bases, and punitive rates that undermine opportunity and fiscal health. So why was Texas 7th? Texas earns high marks for having no personal income tax, a major competitive advantage. But its heavy property tax burden remains a drag on growth. The problem isn't property valuation, it's spending. Local government growth has far outpaced population growth and inflation for decades, driving taxes even higher amid record state surpluses. Texas voters recently approved constitutional amendments that exempt parts of property taxes for certain people, thereby shifting the burden of government spending to renters, employers, and really everyone through other taxes. They also approved amendments to prohibit taxes on capital gains, estates, and security transactions. While these taxes didn't exist in Texas, the move adds welcome certainty for taxpayers and investors of where to park their money and where to have more economic activity. So what have the strong states done, and what do they have in common? Well, states with simple, broad-based, and low-rate tax systems are clearly winning. Those that cling to complex, high-rate, and loophole-ridden tax codes are falling behind. The takeaway is simple. States that trust people to prosper lead the economic race. A competitive tax code should be neutral, simple, and predictable, one that encourages investment and innovation instead of punishing growth or distorting decisions. Related to this, learn how Texas and other states can strengthen their tax competitiveness and boost long-term economic growth in my recent Substack newsletter. Number 4, Pfizer files antitrust lawsuit overall. In the news, last week, Pfizer filed a new antitrust lawsuit against Pfizer and Novo Nordisk in federal court. The suit claims that Novo Nordisk's proposed acquisition of Metsera is an attempt to stifle competition in the fast-growing GLP-1 drug market, which is to help people to lose weight. Pfizer argues that the deal violates U.S. antitrust law by allowing Novo Nordisk to eliminate a potential rival before it gains Pfizer's support. My take on this is when antitrust has become a weapon, it makes more problems, right? Antitrust laws were originally designed to protect consumers, not competitors. The consumer welfare standard, long the foundation of enforcement, focuses on whether businesses' practices actually harm consumers by raising prices, limiting choices, or reducing quality. Unfortunately, under the Biden administration, regulators have abandoned this principle in favor of ideological crusades that expand government power at the expense of economic reality. This case shows what happens when antitrust becomes a political weapon instead of a tool for promoting competition. We've got to restore the consumer welfare standard. To keep markets competitive and innovative, policymakers must return to first principles. That starts with reinstating the consumer welfare standard as the guiding test for enforcement. Antitrust action should be based on evidence of real consumer harm, not speculation or politics. At the same time, agencies should streamline the merger review process to provide clarity and reduce compliance cost. Overly broad restrictions discourage investment, partnerships, and inefficiencies that ultimately benefit consumers. What we need are more free markets, not federal micromanagement. Economic prosperity comes from the competition, innovation, and market-driven growth, not bureaucratic control. Reversing the Biden administration's heavy-handed approach and restoring a market-based framework for antitrust will help businesses innovate, invest, and create jobs. The path to long-term prosperity is clear. Let markets work and keep government interference to a minimum. Related to this, I laid out a vision for antitrust reform at Inside Sources, which you don't want to miss in the show notes page. Number 5, wave of U.S. layoffs and AI's role. In the news, major U.S. employers are slashing tens of thousands of jobs as economic uncertainty deepens. Amazon, UPS, and Target have collectively announced more than 60,000 layoffs this year, fueling fears of an AI-driven white-collar recession. While some companies credit artificial intelligence as a factor in reshaping their workforces, experts say the cuts likely reflect broader concerns about slowing consumer spending and economic headwinds. With the Bureau of Labor Statistics jobs report on hold amid the government shutdown, investors and policymakers are left guessing about the true strength or weakness of the labor market. My take of this is that there's the rise of AI that offers an enormous opportunity to adapt and thrive. Throughout history, technological revolutions have disrupted old industry but created far more new ones. Rather than fearing job losses, high-skilled professionals should view this as a moment to reskill, innovate, and expand their value in the marketplace. Growth comes not from government mandates, but from human creativity and the freedom to adjust to new realities. So we've got to let innovation lead. Free markets work because they allow spontaneous order, where innovation that emerges when people are free to experiment. Trying to pause AI progress through red tape would only cede leadership to competitors like China and the UAE, who are rapidly advancing their own AI industries. The U.S. shouldn't fear innovation, it should lead it. Tackle the real economic pressures is also important. Some of the recent labor force shifts reflect not just technological change, but broader economic uncertainty. High inflation, which is ramping up to close to 4% again when you look at the chain CPI, rising costs overall, and tariff-driven price pressures are weighing on both businesses and workers. The Trump administration can help restore stability by ending harmful tariffs, reducing federal spending, and reining in inflationary policies. By tackling these root causes, we can strengthen the economy and ensure that innovation, not government intervention, drives America's next chapter of prosperity. Related to this, I explored the bright side of similar labor force changes in a previous piece at the Daily Caller. Don't miss that one. Number 6, the price of CFPB's open banking. In the news, a federal judge has halted the Consumer Financial Protection Bureau's new open banking rule while the agency reconsiders its scope. The decision marks one of the most significant financial regulatory moments in years and brings short-term relief to banks and credit unions. My take on this is that the reality is that the CFPB so-called open banking rule, also known as Section 1033, it isn't about consumer empowerment. It's about expanding federal control over America's financial system by forcing banks and credit unions to give third-party fintech firms free access to their infrastructure. This is a price control, guys. Nothing is free. In 2022 alone, banks spent more than $200 billion on digital infrastructure and cybersecurity to protect users and maintain trust. Section 1033 treats all that like a public utility, mandating free access for any third-party app or data aggregator a consumer approves. No negotiation, no security guarantees, and like all price controls, this will backfire. When the government mandates quote-unquote free access, banks have fewer incentive to innovate or invest in cybersecurity, while fintechs are encouraged to ride for free instead of compete, resulting in less innovation, more risk, and fewer real choices for consumers. So instead, we should repeal, not retool Section 1033. This section is the wrong solution to a real problem. It should be repealed, not retooled. The Trump administration's pause and review is a good start, but the rule should be scrapped entirely. If the goal is to empower consumers and protect liberty, which I think it should be, the answer isn't more federal mandates. It's voluntary exchange, private contracts, and free market where innovation and choice thrive without bureaucratic interference. Related to this, you can read my recent piece in the Washington Examiner responding to supporters of Section 1033. That's what I have for you today. Thanks for joining me in this episode of This Week's Economy. For more insights, visit vanceginn.com and get even greater value and more information with a paid subscription to my Substack newsletter at vanceginn.substack.com. Until next time, God bless you and let people prosper.